Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty. We do commercial real estate brokerage in the Southeast U.S. Whatever you need, give us a call. We'll see if we can help you. If we're not the right source, we'll get you to the right source. Visit bullrealty.com for more information or reach out to me directly. My email is michael@bullrealty.com. Well, let's get to the show. We got an interesting one today. You know, there's a lot going on in the world with the new administration, with Trump, and with the tariffs, and with Doge, and just the GSA stuff. It's just really crazy what's going on. But what does it mean for the economy? What does it mean for commercial real estate? Well, you know, my guest is an expert in this. Welcome, K.C. Conway. He is a principal with K.C. Nomics. K.C., good to see you again.
Great to see you, and happy March Madness.
Yeah, there we go. Everybody's happy about that, right? And here we are in spring. So, K.C., let's kind of just start with that. It seems like the tariffs are on everyone's mind, and what's going on there, what's going to happen, and the impact. What should we think about related to tariffs?
Yeah, so we quickly went from executive orders, to Doge to now tariffs or whatever. So the big thing is on these tariffs, they are going to implement April 2nd. My fear is these are going to be a little longer lasting in their nature. They're not just going to go away, and it's not just a bargaining, negotiating threat. And here's why. The big threat to us is China and Europe. They are over half of our $1 trillion trade deficit. So why in the world is Trump picking on Mexico and Canada that are only 25% of our total trade deficit? And the answer, you got to go back to Trump Tariffs 1.0. In that first administration, he put the tariffs in place, but there was a loophole in there. And that loophole is if you moved the last component of manufacturing to a non-tariff company, you were exempt. So where did all of Asia move all of their auto and auto component manufacturing? They moved it to Mexico. So they skirted the issue. So Trump had 4 years to think about it. And he says, I'm not going to have a loophole this time. So by going after Mexico and Canada, what he's really doing, he's going after Germany in the European market. And he's also going after China and a lot of components there. So you think about what that means for us domestically. So think of all the German automobile manufacturing. VW in Tennessee, Mercedes in Alabama, BMW in South Carolina. Think of China with Volvo in South Carolina. So this can have a huge impact on our domestic automobile industry, the assembly of that. So it's really about using Mexico and Canada more to get at Europe and China. The other one with Canada had these great climate change people up there that wouldn't allow pipelines to be built. So they put them in the pipelines that come down into the U.S. So all of their energy that they export to the rest of the world in Europe comes down into the Midwest and goes over to the East Coast and goes over to Europe. And so you put a 25% tariff on that. Wow, our LNG gas looks really cheap out of Pennsylvania. So it's like a double screw to Europe, not just the auto, but also the energy side. And that's why I think Canada and Mexico are so frustrated. They didn't anticipate that.
Yeah. What does it mean for us in the U.S. related to inflation and costs? It seems like in the commercial real estate world, we're concerned about inflation because maybe rates won't be reduced, interest rates, and also just the cost of everything to build out or build new construction.
Yeah, so the big ones are really the metals. So we think in commercial real estate, we use metal studs, we use metal framing. So not like we needed any more office buildings to be built, but we needed a lot of industrial. So the components going into, say, industrial buildings for the steel on that stuff is going to take a big hit. Numbers I'm seeing already, you're looking at 25 to 35% increases just on all the structural steel, metal elements there. On the housing, not that much. We're fine with our lumber here. We like loblolly pine trees from the Southeast. We don't need all of that Canadian hard lumber there. Energy is not a big deal. We're the Saudi Arabia of LNG gas and oil in the world. So it's not going to affect us much on energy, but agriculture will have a big impact. So right now we're bringing egg inflation down by importing eggs from Brazil and South America. So if we put tariffs on that, or do we exempt certain items? So the grocery side, the grocery inflation isn't over. So agricultural is huge. It gets hit. And then, the metals is the big one for us in our commercial real estate industry.
What about the consumer side impact of tariffs?
So what the consumer is already doing, and we see it in the consumer confidence and consumer spending numbers, is they just shut down. And we're already seeing it. So in the latest University of Michigan numbers, they showed whether you're a Democrat, a Republican, or an independent, the numbers in consumer confidence, they dropped like 27% in the last 90 days. So the consumer is already adjusting and saying, I'm not going to pay more for these items. I'm just not going to buy. I'm not going to go buy a new Volvo or a BMW or Mercedes or a VW. I'll just postpone it and maybe buy a used car. So we see used car prices come back up, which we'd finally seen come down. Housing, we're still seeing inflation at over 4%. It's still the strongest item of inflation in the inflation basket bucket. So for the consumer, I think what we're going to see is the way they deal with these inflation tariffs is they quit spending.
Mm-hmm. And does that, it seems like the last time we had tariffs and Trump 1.0, it seems like we didn't have a lot of inflation from the tariffs, did we? Or did we?
No, so they found the loophole to get around it.
Okay.
Just all they had to do is move one thing. Like we put the tires on now in Mexico, or we put the catalytic converter. So now it's exempt from the tariff. So that frustrated Trump. So that's how we got around a lot of it. People were good about finding the loopholes. Trump's learned a lot from that first administration and these tactics. He had 4 years to think about it and a long time to get ready for this. So he's thought this through pretty well. And I think he's willing to roll the dice, and particularly against the Fed. If you saw the Fed chairman yesterday, he seemed pretty kind of frazzled about, well, yeah, I got to admit, growth is going to slow. GDP is going to go below 2%. Yeah, we're just going to have to hold. No more rate cuts. We can't stimulate this thing. So they're frustrated, and Powell and Trump are no friends at all. So Powell's going to do nothing to help bail Trump out of this thing. He's not going to help with rate cuts or anything. So the market and the consumers thinking they're going to get rate cuts or help from the Fed. Nope. Powell and the Fed want to let Trump squirm on his own policies. Yeah.
What about DOGE? What about all this drop in spending by the U.S. government? What's the impact we should think about in the commercial real estate world there?
Gosh, what a cluster, but what a need. So if anything, we've had our eyes open to the level of fraud and corruption that was going on. We're not just talking millions, we're talking billions, maybe getting to $1 trillion. So they've elevated this, but nobody wants to do anything about it because, oh my gosh, look at all the jobs that were dependent on that stuff. So as Trump moves through there and we look at the literally tens of thousands of jobs that he's eradicating. Look at the executive order yesterday to eliminate the Department of Education nationwide. Look at, we're here in Atlanta, the Centers for Disease Control. There is not a major market. You look at the top 50 to 75 metros in the United States, they all are affected by these job cuts. Look at GSA. You're looking for office buildings. Hey, call who's ever going to get the brokerage listing for the GSA buildings. We're going to see a lot of product come on the market. So all that means is that's a lot of hit on employment. And what I'm looking at is they're looking at probably 400,000 to 600,000 job cuts in the government at the federal level. That moves the unemployment rate from 4.1 to well above 5%. Now you ripple effect that through the private subcontractors that are retained in those agencies that now don't have a contract, and then ripple it through the state in state level funding. So I grew up in Colorado. So Colorado is complaining they don't have funds for the national parks and tourism this summer, all the education programs, their university programs, their state universities. So we haven't even figured out what size rock Trump threw in the pond and how big the ripples are. I think he threw a big one in there, and we're going to see unemployment just on DOGE break 5%.
With all that going on, what would be your expectations that the Fed might do with rates? I know you mentioned they're no friend of Trump, but if we have all this happen to the economy and jobs, it creates a job problem. Might they reduce rates to try to stimulate the economy?
So here's a problem. How do rate cuts help government employment? And that's really what they're going to have to address, because the unemployment problem is really going to be coming from the first time in my adult life, really seeing a contraction in government employment at not only the federal level, but rippling down to the state level. I think that they also are going to lose credibility on their inflation mandate. So I think we're going to quickly see the inflation move back to the 4, 5, 6% range. And so if they cut rates, they're not doing it where it's going to help stimulate more government jobs, and then it's not going to do anything on the inflation front. So I think they're backed into a corner. I think Powell you could see that frustration come through yesterday in his news conference. And so I think they're backed into a corner, and I don't think rate cuts, don't expect anything in the first half of this year. No way.
So as an economist, K.C., that you've been doing this a long time, I've always respected your opinion. And so when you look at tariffs in your view right now, where you see the tariffs, is this a short-term pain for a long-term gain for U.S.?
So it is part of the long-term gain. So part of the reason that, I've had a lot of people ask me, so why did Trump move tariffs to the front of the line in his administration in the first 100 days? They got, immigration and law enforcement. They kind of got getting the fiscal. We have a fiscal crisis ahead of us with over $1 trillion in interest on our debt. We got to roll over 25% of our debt this year, $9 trillion. We got another $6 trillion coming on top of that. So that everybody understood we needed to do something there. But why the tariffs? Why did he move that to the front? What was happening at the end of the Biden administration is there was no enforcement actions going on trade. And our trade deficits were like a hockey stick. They were just skyrocketing. So Trump was really forced to deal with these tariffs as much as a fiscal crisis as the trade situation had become. So he had to move that to the front of the line. But you look at what he's put on his plate. You put immigration, seal the borders. You put DOGE and government waste and fraud and getting our fiscal house in order, and a budget reconciliation bill without closing down the government, and now tariffs, and kind of ticking off the whole rest of the world. And oh, by the way, tell the Fed, you're irrelevant. Maybe I'll fire you too. I mean, this is. I don't think we've ever seen anything like this in our lifetimes.
Yeah, it's crazy. So if you're in the real estate world, what do you think? And maybe we look at it sector by sector a little bit. Is there a sector that is short-term or long-term is a winner from all of this?
Yeah, we've talked previously about industrial. And industrial is not going to collapse under the tariffs because we're going to need to bring things in and store and stockpile. So the warehouses aren't going to get emptied out. So they'll do fine. We probably won't see much new construction because the cost of steel and the metals that they need, and then the financing when we're looking at interest on construction loans, and banks still only wanting to do 65% LTVs, even on a new warehouse. So that's going to keep inventory tight. We've worked through a lot of the overbuilding. So industrial is going to do just fine. Don't worry about it. In the Southeast, our ports are very good. Georgia had a record year last year. South Carolina almost broke a record. Our Gulf Coast, Mobile, all the way over to Houston are doing very well. So the other one I like is housing, particularly on the multifamily. So we've been working through an oversupply. We'll only deliver 350 to 400,000 multifamily units this next year. So that's about half of what we've been delivering. So that supply comes down. We're still 4 million housing units short. Total builders will build single family, multifamily only in the 1.4 million range. So, multifamily at less than 400,000, that's not a lot of housing units. Home price appreciation is still moving up over 4%. And even if last year we had the most number of starts since 2016, but that doesn't begin to make a dent in a 6 to 10 year deficit of household shortages. So I like the multifamily. I think that the cap rates are going to come down because people are going to realize maybe I take a little risk and do a sub-6 cap rate on an apartment deal, because if supply is coming down and rents could go up, then I'm going to grow into that sub-6 cap rate with the rents and my NOI going up. So I like the multifamily story a lot because we're not going to fill the gap on single family homes. You can't build anything under 400,000. Yeah. So it's multifamily.
What about retail? I mean, consumer confidence is taking a bit of a hit, you said, right?
Yeah. So retail, we're done with big box apocalypse. It's over with. I've done studies the past year for major national retailers, and in many markets, sometimes we can only find one empty big box left. They've all been repurposed. Barnes & Noble came out and thought they could just go back and release all their empty stores, found out there were none left, that they may have to actually go build new stores, but instead of 80 or 100,000 square feet, maybe it's only 40,000. So big box is done. We're through with most of the mall stuff. So now it's small box apocalypse. Remember these drugstores? Look at the deal that Walgreens just did to go back private with Sycamore. Look at what CVS has gone through. Look at the dollar discount stores. Look at the branch banks. We literally have tens and tens of thousands of these great, well-located small boxes that are ideal for a lot of purposes. Vet clinics, remote office in small chunks, all kinds of opportunities. So we saw in TREP, the delinquency rate in retail, it had been very steady at about 6.5% for over a year. It spiked up at the end of the year. All of that was the closure of drugstores and big box. So the retail problem is, what do we do with all these small boxes? And that's a great retail opportunity, because if you can buy them for south of $50 a square foot, put 20 in them, subdivide them, find an adaptive reuse, they'll sell for over 100.
Yeah. Well, it's usually we sell retail shopping centers in the Southeast, but we only do tenant rep and project leasing in Atlanta. And Atlanta, it's just really tight. It's really hard for the retailer to find a great place.
Yeah. Well, when you don't build anything for a decade, that's basically what we did. Yeah. So what's hotter than a firecracker? Grocery anchored, right? So if you can get a grocery anchored, or a grocer wants to expand, just don't add 50,000 square feet of shop space to it. Just keep it kind of tame.
Yeah. And you mentioned distress. You mentioned TREP. I think of the distress that they track. What do you expect moving forward there on distress levels on commercial loans?
So the nightmare's in office. Mm-hmm. So since TREP's been tracking these delinquency numbers at a loan level, office broke the all-time record of over 11% delinquent. What's moving into special servicing, it just hit 17%. Mm-hmm. So this is a year we're ripping the Band-Aid off. We're going to get price transparency on office. So if you understand a market, you have capital, you know how to multi-tenant or retrofit a building. I wouldn't take on a biggie size it going through the drive-through or buying an office asset, except for a few select markets, but something suburban or a mid-rise. A lot of these make a lot of sense or whatever. The contrarian play, though, is New York. New York, the leasing, the sales are through the roof, and the other one is Miami. The only place we're seeing over $300 a square foot on office building sales is Miami. The flow in out of Latin America, that accessing the Bright Line, where they can go all the way up into Orlando and Tampa, they can bring their families in. Miami is on fire in terms of office. New York has turned the corner, but it's the quality, it's the well located, and it's got to have all the bells and whistles. So, people forget, as you know, these are CapEx intensive assets, and you've got to have either the liquidity or equity sitting on the side with the lender to say, I can come in with another 20 or 30% to do the retrofit.
Yeah. Well, I'm a firm believer of my listeners that are frequent listeners and viewers know. I think contrarian investing in office is something to really consider right now. We just sold a beautiful building for a lender that was over 100,000 square feet for $64 a foot. I mean, it would cost $800 a foot to build it. And we're seeing some buildings torn down. We're seeing some converted. We're seeing almost a stoppage on new supply. And then the growth that we have in the Southeast. So I think it's a great opportunity. But maybe I'm just pro broker on office. What's your view on office?
No, I think, that office, we as Americans think about the stock market. We like to buy at 52-week highs because we think, oh, wow, it's hot. And then we want to sell at 52-week lows. Mm-hmm. We should be doing just the opposite. Mm-hmm. So when we look at commercial real estate assets, we should be buying when it's in trouble, distressed at the bottom, not at the peak. And so I say, go back and look what happened in retail and big box. Mm-hmm. We threw it all away. It was worth nothing. Then we don't build any of it for 10 years. And now everybody's scrambling to figure out how they can find something, pick it up, or how to make the numbers work on a new build. Mm-hmm. Office is going to be in that same boat. I think it's going to be more bullish in really well located suburban markets. I'm less bullish on the downtown urban markets. I don't think people really want to come back to commutes and parking and the urban centers. They want to do that for hotel. They want to do it for entertainment, go to the NCAA tournaments, and dine out. But I don't think they want to do the commutes. They like being closer to home, being fully engaged with family, and having less expense. So I'm very bullish on the suburban, very bullish on the well-located, kind of more mid-rise type stuff. Mm-hmm. I'm very anxious about the high-rise urban CBD type stuff.
Yeah. Well, we're seeing some buyers get some great deals, and a lot of users that we help, companies that use space, buying buildings that, I think we're going to turn around in 5 years and go, wow, what a windfall, especially if you're a user. You kind of fill some of the vacancy, right? We talked about some of the property types. Then you mentioned hotel. What do you expect there? They're doing well now. What do you expect moving forward?
So again, bifurcate. So distinguish convention urban hotels from more destination type hotels. So look at here in Atlanta, we just had the Atlanta Hilton go sell distressed at an auction for well below what it originally or last sold for almost 10 years ago. And you look at the capital that's going to have to retrofit that. The convention business has not come back like it did pre-COVID, particularly for markets like Atlanta. So those asset types are capital intensive. They're big. They take a lot of money. Banks don't want to take them on, but they will go on destination. So if you go to a small market, in Asheville, North Carolina, you go to an Orlando, or you go to a Tampa, or you go to a Miami, and do a lot of hotel type stuff. It's insane. The numbers, the capital flowing in, the prices are absolutely incredible. So I just did a big litigation case out in Colorado for the largest convention hotel out there, and the tax assessor had taken the value from 1x to 2x in 1 year. Highest tax increase in the history of Colorado. So the tax assessors have said, this is where we're going to go make up for it. We're going to pile in on the hotel side. So the hotel, I worry about the convention. If you're hooked and addicted to convention or urban stuff, I think they still have a road to recovery, but more destination. And it doesn't have to be a primary market. It can be good secondary markets that you can find good hotel assets in, because the cost to build these things are just ridiculous.
Yeah. K.C., where are some opportunities as you kind of look at where we are today here? It's spring now, and Trump has been just doing things so fast. It's kind of fast and furious, isn't it? Where might there be some opportunities?
Yeah, so I think, I always go back to my favorite Christmas present each year, which is the U-Haul moving report. Look at where all the U-Hauls are going, and they're going south. Really, they're leaving the West Coast, they're leaving the Northeast, they're coming into Texas. Texas is on a track to displace New York as the financial center of the United States. You look at the financial companies, the financial service office leasing in Dallas is off the charts anywhere in the country. So look at where the migration is going. And they're basically going into states that have their fiscal house in order. They have an ability to fund infrastructure, because with all this growth, you got to build roads, you got to build infrastructure, you got to build schools. So look at states that are that way. We're in Georgia, we're in good shape. Tennessee, the Carolinas, but many of the Midwestern markets have got their house in order. So I like Midwest markets like Columbus, Ohio. So Midwest, I like. Texas, we know the story is still very strong there. In the Southeast here, it's hard to pick a bad market.
Yeah, and you talked about the multifamily world. There's been a lot of deliveries of a lot of Class A space in a lot of markets, including if we use Atlanta for example. So rents kind of leveled off, right? They were increasing so fast, and now they've leveled off. In some cases, come down. But really, new supply deliveries are kind of slowing down as well. What do you expect for development? Do you think development kind of cranks back up, or these tariffs slow it down even more?
The tariffs will have a sobering impact, because just the materials, the metals, and all that go into it is going to have an impact. We're going to have a supply chain disruption, not too dissimilar to what we went through in COVID. So it's going to get all disrupted on where's it go? How do we get it in? How do we get eggs in here to deal with, our destroying all of our chickens and hens or whatever? How do we reroute that stuff in? Do we get exemptions, for certain pieces of agriculture, for certain, does Ford and GM get an exemption for their auto components out of Mexico that Germany doesn't get? I mean, we haven't even begun to see that negotiation play out. So I think what it means right now, I call it, my theme this year is recalibration, frequent recalibration. As frequently as Trump issues orders daily and weekly, we're going to have to figure out how to deal with the new hand dealt us. So it's going to be like playing poker, and we don't know that we're playing 5-card draw or seven hand, one hand eye peeky or whatever. We're not going to know the hand until he deals the cards and then tells you what we're playing. And so we're going to have to be flexible to deal with that, and I think be patient. I wouldn't overreact. I wouldn't overreact to a no decision, and I wouldn't overreact to a yes decision. And the key determinant is, where is your capital position? What is your relationship with your banker? What will your banker do? We still have CRE concentrated banks out here. Some of them are kind of working their way out of that. A Synovus, a Pinnacle have kind of worked through their issues, but they have a lot of multifamily construction loans that they got to get out of there. So how are those going to work out? They're going to require some new equity to come in and fill the gap between what was underwritten at 4 cap rates and 4 or 5% rent growth and 2% rent growth and 6 or 7 cap rates. So that's all got to rebalance out. So I would be very close to my banking relationships, my equity relationships that can come in, that understand what markets. Don't shotgun blast them and say, here's 10 markets we all rush into. Give them 2 or 3 and really do your homework and do it right. And then know that inventory. Know what if there's 10 assets on the market, like I told last year, I was going through with merchant developers, if you've got spec industrial buildings, know how they rank out from number 1 down to number 10. And the market has been out there absorbing 1, 2, and 3. And as those disappeared, now they got to settle for 4, 5, 6. Same thing with multifamily. What are those 1, 2, 3? School districts, proximity to work centers, dependency on certain industry. If you're up in Knoxville, I'd be a little leery because I've got the automobile manufacturing. I've got Volkswagen. I got things that are going to hit me there. If I'm in Alabama, if I'm in Huntsville, I'm going to worry a little bit about Toyota and some of the automobile manufacturing. So you got to recalibrate. What are the influences? And just as quickly as they can turn negative on us with this administration, they could change in 90 days. So be patient, be flexible.
Yeah, good advice, K.C. As usual. Thank you, sir, for being on the show.
Absolutely. Thank you. And good luck with all your brackets.
Yes, thank you. You too. And thank you for joining us around the country. Let us know what you think. Hey, please share the show if you will. Connect with us if you will on your favorite social media. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.